Let's be real for a second. For most people, the word accounting just means headache. It feels like this secret club with a bunch of rules you're supposed to just know. But what if I told you that's all wrong? What if the real key isn't memorizing anything, but understanding one incredibly simple secret?
Yeah, exactly. Why is it so confusing? You've got all these weird terms, rules that seem totally random, and this constant fear that you have to memorize every single journal and ledger entry. You'd think it was designed to be complicated. But here's the thing, it's really not.
No, seriously. Forget memorizing. There's a core idea, a kind of secret formula that makes everything else just click into place. Once you grasp this one thing, the need to memorize disappears because it all starts to make perfect logical sense.
And this is it. This is the big secret. All of accounting, whether it's for a kid's lemonade stand or a giant global company, is built on answering just two simple questions about that business. That's it, just two.
And what are those two questions? They're as simple as this. What does it have, and where did it come from? Think about it. Everything a person or a company owns had to come from somewhere, right? That idea is the heart of it all. To really see how this works, let's step away from business for a minute and start with something a lot simpler. So, I want you to meet Udin Gambul. We're going to apply our two-question secret to Udin and his snacks. Now, I know this seems really basic, but trust me, what you're about to see is the foundation for everything in accounting. Okay, so let's ask our questions. Question 1, what does Udin have? Well, he's got some corn, a pizza, and a hot dog. Simple enough. Now for question 2, where did he get it? Well, the corn he bought with his own money. The pizza, he didn't have enough cash, so now he owes the pizza guy. That's a debt. And it's the same story with the hot dog. He owes the vendor for that too. You see the two sides, what he has on the left and where it all came from on the right. And that is the fundamental principle. The two sides has to be connected. They're two halves of the exact same story. Every single thing you have must have a source. It either came from your own pocket or from someone else who you're going to have to pay back. The two sides will always, and I mean always, balance out. Now, here's the really cool part. That exact same logic, what do you have, where did it come from, that we just used for snacks, well, it applies just as perfectly to a massive company. The numbers get way bigger, and the items are a lot more complex, but those two fundamental questions never, ever change.
So let's try it with a company. What does it have? It's got $100 million in cash, a $10 million computer, and a car worth $500 million. Okay, now for the other side of the story. Where did it all come from? The cash came straight from the owner's pocket. The computer was bought on credit, so that's a debt owed to the store. And that really expensive car? That was paid for with a mix. The owner put down $50 million, and the company took out a $450 million loan for the rest. See, it's the same thing. We know exactly what it has and exactly where it all came from.
All right, let's do the math. What the company has, $100 million in cash, plus $10 million for the computer, plus $500 million for the car, that adds up to $610 million. Now, let's look at where it came from. The owner's money plus all the debt. That's also $610 million. It balances perfectly, and that perfect balance, that accountability, is the entire point of accounting. Okay, so now that you get the logic behind it, it's finally time to put the official accounting names on these ideas. But don't get nervous, these aren't new things to memorize, they're just labels for the concepts you already understand. First up, that whole what it has column, the cash, the computer, the car. In the world of accounting, we call those assets. An asset is just any resource the company owns that has value. Next, let's look at the where it came from column. That debt, the money owed to the store, the big car loan, accountants call those liabilities. It's just a fancy word for what you owe to other people. And finally, the other part of where it came from, that money put in directly by the owners themselves, that's called equity. It basically represents the owner's own personal stake in the company. So let's put this all together. What you have, your assets, must be equal to where it all came from. And that source is always a mix of what you owe to others, your liabilities, and what the owners put in themselves, your equity. And that brings us to the single most important equation in all of accounting. Assets equals liabilities plus equity. And I can't stress this enough. This is not some random formula you need to memorize for a test. You now understand why it has to be true. It's the logical conclusion of our simple two-question secret. You could say it's just common sense with a fancy name tag. And that just reframes the whole thing, doesn't it? When you pull back the curtain and strip away all the jargon, you see that accounting isn't some scary book of rules. It's a logical, elegant system for telling a story, the story of what a business has and where it all came from. So is it all just common sense? In a lot of ways, yeah, it is. And knowing that is the key that unlocks the whole world of finance and makes everything finally make sense.